All right, so we are going to get started. Welcome, everybody. Thank you for joining us to the webinar, Stop Paying Someone Else's Mortgage, Become a Homeowner in 2023. My name is Elizabeth Aloni, and I'm with Schneps Media. Schneps Media is the largest local media company in the New York metro area. We publish over 80 newspapers, websites, webinars, podcasts, and events throughout Queens, Brooklyn, the Bronx, Manhattan, Westchester, Long Island, the East End, Philadelphia, and Palm Beach, Florida. And today we brought together top experts to help us learn how to stop paying someone else's mortgage and become a homeowner. So let me introduce our fantastic panel of experts. First, please welcome Claudia Alvarez. Claudia is a licensed real estate broker with the agency. Welcome, Claudia. Tell us a little bit about yourself.
Thank you. Thank you for having me on. I'm excited to be here. So my name is Claudia. I'm with the company, The Agency. We're based out of Huntington. I've been doing this for quite a few years now. And I'm just excited. I service all of Long Island, Nassau County, Suffolk County, along with Queens and in the boroughs as well. So I'm excited to give some information today.
Fantastic. Thank you for being here. Next, please welcome Sydney Hahn. Sydney is a mortgage loan officer with Clifco. Welcome, Sydney. Tell everyone about yourself.
Hi, everyone. I'm also very excited to be here and to share some of this information. I have been in the finance industry for quite some time. I started out with actually business banking and really took a love for mortgages at the depositories when I worked there, and have been a mortgage loan officer for a few years now. It's something I'm super passionate about because it's not something that we're taught in school, and it's not something everyone does every day. So there's a lot of information around it. And I really love educating people on the process and what you can expect. So I'm excited to do that today.
Fantastic. Thanks, Sydney. Now, please welcome Vincent Campasano. Vincent is a real estate attorney with Campasano Law. Welcome, Vincent.
Thank you for having me. Yes, I'm located in West Islip, New York, in the middle of the island. Been doing real estate almost exclusively for 35 plus years. Representing buyers, sellers, lenders, builders, and my own real estate as well. So that's pretty much all we do at this point, is represent people involved in all sorts of real estate transactions. So happy to be here and happy to help in any way I can.
Wonderful. Thank you so much, Vincent. And finally, welcome Katie Doig. Katie is the Director of Business Development at Safeguard Credit. Welcome, Katie.
Hi, thank you for having me. I have been at Safeguard, a nonprofit HUD housing counseling organization, for 12 years. I'm excited to share what a HUD housing counseling organization is and how we can assist you in getting ready for home ownership.
Fantastic. As I promised, a true panel of experts. So let's get started to learn how one can become a homeowner. Because when I think about buying a home, the first thing I think of is, let me look at the houses. I'm so excited to see the houses. But there are really important first steps that should come before open houses. Katie, where should we start?
Yes, how the home buying purchase is the best part. Absolutely. We want to rush to that. But first, we want to get some things in order, and that starts with our finances. So one of the things that we want you to do is look at your full financial picture first. What can you afford? Where do you want to go? Where do you want to be? What are the needs of your family? And one of the ways that you can get that information put together is by reaching out to a HUD housing counseling organization and talking to a HUD certified housing counselor. Now, Safeguard is a HUD certified housing counseling organization, and we provide assistance with anything related to housing. The most important component here is that this service is free. It's federally funded. It costs nothing for you to talk to a housing counselor and get prepared. So Safeguard assists people in the whole state of New York as well as North Carolina. That's where we have our offices, but you can talk to a housing counselor in any state. The best way to find a housing counselor is to go to HUD.gov. There's a section for becoming a homeowner and buying a home. You'll go to that section, you'll type in your information, and it'll direct you to the nearest agency. But what I want to talk to you today about is how to get ready. What can we help you with to get you home ready? And that's what we call it, home ready. And so let me talk about some of the ways that we use HUD housing counseling to assist people. The first is getting you pre-purchase counseling. So this is where we maybe talk to you over the phone, or we sit down with you and we say, what can we do to get you there? So let's say you have a double income, you have 2 income earners there, and you're making 100,000 total. Well, that's great for some people, but let's say you have 1 income and you have 3 dependents. Well, then you're going to have different requirements. We want to talk about those things with you. Another huge component of getting home ready is your credit score. Having a higher credit score means you're going to be less of a risk to a lender. So we want to get that score nice and high, and we can help you with that. And again, it's absolutely free. There's no charge for us to assist you with this and review all that information. We do not discriminate. We assist people buying $1 million homes. We assist people that are first-time home buyers. It doesn't matter what stage of life, what walk of life you're in, we help everyone. So we just want you to use us as a reliable resource for information. There's no question too small. There's no question too big. All right. Let's go into some of the topics that we review often with people when they come to us for pre-purchase counseling. And one of those components is your credit score. So let's talk about the differences in credit scores. There are some people that will come to us and say, I pulled my credit, I went to the lender, they pulled my credit. I know I have a 740, but they told me I have a 680. And I probably know why that is. There are different scoring models out there, and one of those is called the Vantage score. So who uses a Vantage score? That's people at Capital One, Credit Karma. A lot of people use Credit Karma to look at their credit, and they get a score there. That's your Vantage score. However, that scoring model is different than what the lenders use. Lenders use the FICO score. So we want you to remember the FICO score is the score the lenders use. And how are you going to get information on your FICO score? Well, there's some great resources where you can find your FICO score. The first is annualcreditreport.com. That is a website that you can go to. It used to be that you could pull your credit score there once a year for free, but since COVID, it's now once a week. And there's 3 reporting bureaus. There's Equifax, Experian, and TransUnion. And you can go on there and you can get information from each of those reporting bureaus. Now, they're going to give you the details of the credit report, but they're not going to give you the actual score. So it's great for looking at that information, but it's not going to give you the score. I think they have a small extra charge for that, but you don't need to do that. Another resource that you can pull from is your current credit card. So now oftentimes you'll see you can pull your credit score. It's a soft pull, and they'll show you what it looks like. But again, we want to make sure that's the FICO score and not the Vantage score. So Vantage score, if you have a Capital One card, that's probably going to show that. But the best resource for pulling your credit and having a soft pull, remember, this is no ding to your score, is through a HUD housing counseling agency. When we pull it here, we're pulling your FICO score, and I'm pulling the specific model that the lenders use. And that's a classic model. I see the FICO score and I see all the details. So we can help you work through that. We might pull it and it's a great score and you're home ready and we're ready to move forward and say, yes, let's reach out to a lender. But we might look at it and say, you know what? It looks like there's some errors here. Or maybe if we worked on these few items, we could get that score nice and high in 6 months' time. And that can mean the difference between a much higher interest rate and a lower interest rate and save you thousands of dollars. So getting prepared is such an important component that oftentimes people overlook. But we want you to just take a step back, take a breath, and let's get prepared, okay? Another issue that comes up often is pre-qualification versus pre-approval. And Sydney's going to chat a little bit more about this with you guys. But when you go to your lender, there's 2 ways that you can get an approval letter that you can take, and your realtor might ask you later on if you have something that shows that you're qualified for a mortgage. So when you go and get a pre-qualification letter, you're providing that information. So the lender might ask you, well, how much do you make? And you provide that. They may or may not do a credit pull on you, and it could be a soft or hard pull. So we want you to check that. because any hard pull can have a soft or a slight ding to the score. So we want to make sure when you're ready, you go and do that, but we don't want you doing it too soon. So in the pre-qualification, you're going to provide that information, and then they're going to give you a letter that says, based on the information you provided, this is what you're qualified for. The difference between that and a pre-approval is a pre-approval, they are checking that information. They're going to confirm that information. So if you say you make a certain amount of money, then they're going to say, okay, do you have some pay stubs? They're going to do a hard pull on your credit and make sure everything lines up. Then they're going to give you a letter that says, based on the information that we've reviewed, this is how much we would approve you for. You're going to take that letter and you're going to go to get a home now. And the realtor is going to use this as a tool. And let's just say that you go to you see a house you love and you put in an offer and someone else puts in an offer for the same amount. Well, one of you has a pre-qualification, one of you has a pre-approval. The pre-approval is going to have more weight than the pre-qualification. Why? Because we know that information's been verified. So Sydney's going to talk to you more about this, and we're going to learn a lot more about the lending process. If you have any questions, and if you gain nothing else from my conversation here, just remember HUD housing counseling is free and it's available to everyone. All right. And Sydney, I'll take it to you. Tell us more about the lending process.
Thank you, Katie. So applying for a home loan, it can seem very daunting for a lot of people. It can seem very complicated, but this is why you work with a professional that really knows their stuff, has the knowledge, because we're here to guide you through this process. And actually, the pre-approval process isn't as terrible as you might think. Technically, I don't give out any pre-qualification letters, actually. So based off what Katie was saying, I definitely make sure I verify all information. What happens a lot is, especially here in New York, you'll see that some of the bigger companies, maybe like Better Mortgage, things like that, they will give out pre-qualifications letters. You have to fill out an app. It takes 10 minutes and they issue you a pre-qual letter. This hurts you in ways because a lot of your offers won't get accepted, like she was saying, with those letters, because they know that documents haven't been looked at. And there's a lot of guidelines when it comes to the mortgage industry and how you get qualified and how you get approved. So we want to make sure that any red flags that come up during that process, we deal with immediately, so we can get you to a place where you can get into a home and get that home loan. So I just want to start off. Can you guys see this top black bar here? I don't know why it's not going away. No? Okay.
I think you're good.
Oh, it looks
Okay.
good.
So we'll go over the mortgage pre-qualification process. And I guess technically it should be called the mortgage pre-approval process. But what I like to do with my clients is first have an initial consultation. I want you to ask me whatever questions you have, whatever concerns you have, so I can really start to explain the process to you and things that we'll look into and things we'll do during that process. And I want to find out a little bit more about you, what you're looking for, where you're looking, whether it's a condo, a townhome, things like that. And also your history. So I know what documents to request from you, your work history. There's a lot of stuff. People go on maternity leave, people have disability, things like that. So this is a very important conversation to have. And then the easy part, we send you a link for an online application. You fill out your information with your employer's information, and everything is a 2-year history. So employment history is a 2-year history, residential history is a 2-year history. And then I take your application and I review it and I request documents from you. These might be W-2s, most recent 30-day pay stubs, a driver's license. There's a lot of misconception that you always need tax returns. If you're a W-2, employee, you do not need tax returns. There's misconception that if you have a salary job with an offer letter that you still need 2-year work history. That's not always the case. So really having that conversation and going over all this is really important. But once I have those documents in that application, I do build your file into the system, which calculates your debt to income ratios. I pull your credits, look at your liabilities, any other homes that you own, things like that. And I issue a pre-qualification, or I should say pre-approval letter. We go at Cliffco Mortgage one step further because especially with this environment and how competitive it is, listing agents really want to know that when they're accepting your offer, that you can get that loan or that your lender can get that loan closed. So usually you'll see on number 5 on the mortgage closing process, there's a commitment letter. We actually issue that during the pre-approval process and call it a TBD commitment letter. That means an underwriter has reviewed all the information, not just myself, but underwriting has as well. And they said, we are committing to funding this loan with a to be determined address. It makes the closing process much faster because we've already addressed anything that the underwriter wants and any red flags that the underwriter sees. So we can close much quicker. It'll help you get your offers accepted because they know an actual underwriter has looked at the file. We just got to plug in an address, get an appraisal, and that's about it. So the mortgage closing process, once you find a house that you love and your offer is accepted, you will get a purchase agreement. Once we have that, I can submit the file fully with that purchase agreement in there, and you'll receive something called initial disclosures. And that's what I'm going to go over next is the loan estimate will be included in your initial disclosures and throughout the entire process. Once you sign that, we order the appraisal. We lock in your rate if you want to. We have a whole discussion on that because there is options with rates. You can buy down points. You can go higher and have less closing costs. It's a really important discussion as well because we want to make sure you're comfortable with not only the closing costs, but also the monthly payment. And we go over this actually before you even put an offer on a house that you really like. That's what I do with my clients at least. So you know what monthly payment you're looking at with those property taxes on that specific house. Then we get a conditional approval from the underwriter and a commitment letter. And we submit those conditions. The conditional approval means we approve this loan with these conditions. Maybe the underwriter wants updated pay stubs or a letter of explanation for an address on your credit report. And we submit those to the underwriter and then they give us the clear to close, meaning you can schedule the closing date and then we close with the attorneys and the loan is funded. So that is the entire process. I want to go over the different types of lenders because there's a lot out there. You'll see a lot of, advertisements. My general rule is if it sounds too good to be true, it usually is. And here's some knowledge that you can take with you on the different types of lenders and the upsides and downsides of them. So one, we have the depositories. So a depository is anywhere where you can deposit money. So your Chase, Wells Fargo, Bank of America, things like that. There's also mortgage brokers. So mortgage brokers are going to be kind of a middleman. So they have their broker's license. They take you as a client and then they place your loan with one of a bunch of different companies that they have contracts with. And then there's direct lenders. That is what Cliffco Mortgage is. We only do mortgages. We fund the loan ourselves. And that's it. There's no middleman. There's no, everyone's in the office, etc. So things to consider when you're choosing a different type of lender is listed on the bottom right. And I'm going to go over those, but I do want to say the reason I chose to work at Cliffco Mortgage is because we are a direct lender and because of the programs and whatnot that I have access to there. I have worked for a depository. I have worked for a broker. I have worked for a direct lender. I have worked at a direct lender where brokers were brokering out their loans to me. I've been an account executive on that side. So I've really seen kind of how this all works from many different angles. And I know that I will probably never work for anything else besides a direct lender while doing mortgage loans. So turn times is huge. Depositories, their underwriters are typically in another state. They work 9 to 5, Monday through Friday. Me, you call me 9 p.m. on a Saturday, I'm probably picking up my phone. Approval oversight, that's a huge thing too. When you're a broker, you're sending a loan to another company, another underwriter. Our guidelines that are on top of whatever guidelines Fannie, Freddie, and FHA have are Cliffco Mortgage guidelines, not another lending institution. And if there's an issue, I can walk into my underwriter or my underwriter's manager's office and go figure out that issue, sit down with them and try to figure it out. Again, the working hours, you need someone that's always available. Real estate does not sleep at all. And then access to the operations team. So being able to push certain things, being local, working with, the people that have been in this industry and done these things for a long time, that we know that can get the job done, because a lot of hands touch a loan when it's going through process. So this is the loan estimate that you will receive when you get initial disclosures. I actually issue this sometimes to people when we have to go really in depth because they have a certain situation, even before they find a house, just so you can look at it. I usually go over this with you. But you'll receive this during your initial disclosures. You'll receive it when you lock in your rates, and you'll receive it again when you get your closing disclosure. So you'll receive it several times through the process because it can change a little bit throughout the process. But there's some good information on here, and this is the main thing that you should always be looking at. So you'll see right here in the top right corner, it says rate lock, yes or no. This says yes. This is huge because the rates, the market changes every day. The rates and the price of rates change every single day. So if it says no, this doesn't really mean anything until this is locked, right? And it's locked for either 30, 45, or 60 days. It goes over your loan amount, interest rate, your monthly principal and interest. And then, obviously the general information, the property, the applicant, your loan term, things like that, conventional or FHA. And then this is the same first page, but the bottom of it, and it'll have your projected payments. It'll have your mortgage insurance, your estimated escrow, which is going to be your homeowner's insurance and property taxes, and then your total monthly payment. Now, if there's anything that's down here that is not included, such as HOA, it'll say other, and it'll say included in escrow, no. Then this is a very important page. Let me scoot this over. I don't know if you guys can see this. So your closing cost page is page 2. Now, this is what I really go in depth with my clients over. I'm going to give a brief overview. Of course, if you have any questions at all, please feel free to reach out. But this is a great way to compare apples to apples, what you're getting from different lenders. And, like I said, that locked, making sure it's locked is key here. But section A is going to be any and all bank costs, bank associated costs. So you might have points if you choose to have points, application fee, there might be a processing fee or an underwriting fee, but section A is really the only thing we have control over. Everything else here, B, C, E through H, that is all going to be third-party costs. So a lot of people see, now this closing cost this is just an example. This is very, very low. This is not typical in New York. But people see this number down here and think that we're charging you $20,000 to get a loan. It's not the case. It's just the costs that come with purchasing a home. So section B, you'll see appraisal fee, credit report fee. There's some other things in here that may or may not be included. Services you can shop for is going to be, title fees. The title company sends that over to us. You are able to shop different title companies if you would like, but typically we use one that is, we know is going to do a good job because they play a very important role. Pet inspection fee, that is not for conventional loans. E, you'll see recording fees and other taxes and transfer taxes. Transfer taxes you definitely will have in the state of New York. New York charges a mortgage tax when you take out a mortgage. So that will be there. Prepaids, you always pay when you purchase a home 12 months of homeowner's insurance upfront. So this says 6, but it would be 12. And the reason for that is because you pay for a year, starting from the day you move into the house. You're covered for a year and you're making payments those 12 months that are going to go into your escrow account for homeowner's insurance. That way, when it's due again in a year, there's enough in your escrow account to pay that homeowner's insurance again. So this will be the only time you do that. But when you do purchase, you pay for it up front. Initial escrow payment at closing. This is going to be to build your escrow account, that escrow account that I'm talking about that pays your property taxes and homeowner's insurance. Depending on, we put a couple months in there for homeowner's insurance as padding. And then depending on when you close, depends on how many months of property taxes we put in there. If we're 6 months out from property taxes being due, we put 6 months in there. That way your next 6 payments, there's another 6 months in there. And that way when the property taxes are due, you have a full year of property taxes in there. Owner's title policy, it's optional, but usually people get it. And then you'll see right down here, cash to close. So total closing costs, your down payments, the deposit you made, any seller credits you have, it'll all be calculated right here. And this will be the total amount that you're bringing to the closing table. I think that is it for me.
One second. Sidi, would you go back to that page? I just want, can you discuss what points are for people? Because we often get that question. Can you discuss what that is?
Of course. So, and that's what I was going to say too, before I pass it off to Claudia. You know, it's really important to work with someone that's local, that knows the market, and that has a really good relationship with their real estate agent. Because there is special cases for everyone. No loan is not unique to that borrower. Everyone has different needs, whether it's you're 1% over the debt to income ratio and we need to buy down the rate to make your monthly payment lower and to make your debt to income ratio lower so that you do qualify for the loan. There's some people that don't care about their monthly payment or how high it is. They just want as little cost as possible at the closing table, or they don't have the money to buy down the rate, or they just really prefer lower monthly payment. So buying down the rate is like this. So when we price out your specific file, we get a list of rates and a list of prices next to those rates. The higher the rates, the lower the price of that rate. So when you buy down the rate, you are getting a lower rate and you're paying a higher cost for that rate. And that comes out in points. So you'll see section 8, 0.25% of loan amount points, $405. Now, it's not equal on every file. It's not like I pay 1% of my loan amount in closing costs to get a 1% interest rate reduction. It's not how it works. It's unique to every file. But what I do is I make an Excel spreadsheet for my clients that are on the fence, and I lay out this rate is your monthly payment, and this will be your cash to close. This rate is this monthly payment. This will be your cash to close, etc. However many options they need, we lay that out for them. And then the realtors I work with, we also do that if they find a home that they really like that they want to put an offer in on. Well, it's scary to put an offer in on a home if you don't know what you're going to be paying monthly on it, right? So we actually lay that out beforehand to make sure that they're comfortable with the amount of cash that they'll need to bring to the closing table, and they're comfortable with that mortgage payment, because that mortgage payment will also change depending on the house, because property taxes change on every house, right? And the loan amount can change the interest rate as well. So we really want to make sure that everyone is comfortable in making an educated decision. I wanted to touch on one other thing when it came to closing costs. And so when you're working with a realtor as well, there's other unique situations where maybe someone only has, $15,000 saved. And to get into the house that they really want, they'll qualify for it debt to income wise and credit score wise, but they don't have enough cash to close. So that's where we work with the realtors as well. And for example, if someone needs, a $30,000 concession when I do the pre-qualification, that means the seller would be paying $30,000 of the borrower's closing costs. It's hard to do right now, but it is being done. So for example, if Claudia is putting an offer on a house or wants to put an offer on a house that our client wants that needs $30,000 in concessions, she's talking to me, calling me, saying, I want the seller to net here, right? Because if they're purchasing it for $650,000, but the seller's paying $30,000 of the buyer's closing costs, really the seller's only making $620,000 on it, not the $650,000 that they're purchasing it at. So that's how that works. And so, Claudia will call me, say, hey, I want this seller to net $650,000. So, but I don't know how much in concessions they need on this particular house. So I'll plug in the house, that house's numbers. They need this much concession. Now it's $25,000 instead of $30,000 on this house. So you need to offer, if you want them to net $650,000, offer $675,000. Do you think it'll appraise at $675,000? These are all conversations that me and Claudia would need to have to make sure that your offer is still going to be accepted, and that we can close the loan on it as well. So does that answer the question for the most part?
Yeah. And if anyone has any more questions, again, feel free to put those in the chat or reach out to us directly. But definitely I can tell it's important that you have a great relationship with your agent. So let's take it over to Claudia, who's going to discuss the agency and what you can provide over there.
Yeah, although I want to check in with Vincent. I know, did he raise his hand? Did you have a question?
Oh,
Vincent?
yes, Vincent.
No, that's fine. It was just something that Sydney was covering, but I'll dovetail into it when I'm talking. That's fine.
Great.
All right.
Sorry, I didn't see your hand there.
That's okay.
All right, so welcome to the fun part. We get to go house shopping. Okay, so one of two things can happen. It can be that someone is already pre-approved and they come to me, or it can be that they come to me with absolutely no direction, and it is up to me. I like to consider myself a matchmaker to kind of sit down and listen in on what your situation is and kind of guide you and direct you to a loan officer that I work with that I think is going to best suit your situation. So what I like to do sometimes, you know, buyers get happy when they receive a pre-approval. However, I think that your sit down and your conversation with your loan officer is extremely important before we go out to look at houses. I think that it should be as thorough as Sydney just made it. You should be aware of what your down payment is, what that percentage is. You should be aware of what your closing costs are, and you should be aware of what your monthly payment is going to be. What is the range that you want to stay between? Just because that's how I go out into the inventory and look at houses to see, and so I can present them to you. I want to stay within your budget. So once you have that conversation, you know, it can be, you know, a lot of people are concerned right now about the interest rates. You know, it's crazy. What should I do? Should I buy? Should I not buy? And a lot of people are trying to time the market. However, I don't think that's something that you can do. And so when, you know, you don't have control of something, I think we should focus in on what you do have control over. Some of those things are, you know, security, financial security. You know, do you have a good job? Have you been there for a couple of years? Do you have money for your down payment? Do you have money for your closing costs? Is your credit healthy? Do you have savings? You know, if all, you know, your answer to all those questions are yes, then yes, you should definitely move forward to make a purchase. I think that a lot of people, you know, like, again, going to the interest, it's a financial investment, but it's also an emotional investment. So what is your ultimate goal to buying a house? There's so many reasons, and I think that deciphering that on the forefront is extremely important. So once we figure all of those things out, I like to sit down with my clients and I like to have what's called a buyer's consultation. I like to get to know you, because to me, it's very important to have a relationship. I like to get a little personal, because this is like it's a, you know, it's a big decision. It's very personal. So some of the questions are, what neighborhoods are you interested in? Why? What are your wants, your needs, and what are your non-negotiables? How many bedrooms, how many bathrooms are required? How big of a house do you need? Do you need a garage? Do you need a basement? Does the style and the layout of the home matter to you? I think that sometimes some people don't think about these things prior to. Another thing is, are you open to doing repairs, cosmetic work? Do you have the funds to do that? If you don't, this is another conversation that Sydney, the loan officer, and I would have. It's like, maybe we can consider a 203K loan. I don't know if Sydney, you want to tap into that a little bit and kind of describe like what goes into that, or just because I think this is another good option sometimes when people feel like I can't afford, or there are houses out there, however, it requires too much work. I think that this is always a good option and just another route to go down.
Yeah, so really it's just, I mean, I'll give a brief overview. But it's really just financing the home on top of financing repairs. There are limits on, you know, if it's, you know, below this amount, it doesn't require a HUD advisor. If it's above, it does. You need to have a contractor that is licensed. They can't not have a license. All of those repairs need to be, or I guess repairs or improvements need to be approved. And the budget needs to be approved, but you close on the home and then they basically distribute the funds. I think it's like 50% in the beginning to the contractor to start to buy materials, to start construction or whatever you're doing. And then they disperse it periodically throughout. And then they do an appraisal in the beginning based on what you're going to do to the house. And then the appraiser comes back out, make sure it's all done, and then it's a done deal. So it is a way to finance, a fixer upper for sure. You can't use this loan to like put in a pool or something like that. But yeah, definitely if a house is in need of some work and you love it and you love the location and it really just needs some work, this is a great way to go about it. You do have to qualify for that loan as well. The entire amount of the loan for the mortgage plus the construction. But it is a great option for sure.
Yeah. So this goes back into, just seeing yourself in the future and what is your ultimate goal? What are we trying to accomplish here together? So I love to sit down. I love to have this buyer's consultation once we have everything in order. I don't know if you want to go to the next slide, Sydney. I think getting familiar with inventory is extremely important. I think it's more likely than none where somebody says, you know what, I want a 5-bedroom, 3-bathroom, I want a garage, 2-car garage, I want a basement, I want a pool, $350,000. All right, let's take ourselves back to New York. Let's take ourselves back to Long Island. And, let's set some real expectations. Let's get familiar with what the inventory looks like. So I like to always just kind of send my clients a couple of houses just so they could get real familiar with what's out there and they can, stay, just so we can stay within our budget. And then, like I said, we can look to see what a renovated home looks like versus a non-renovated home and what are we willing to do. So once we go out, we look at some houses. Let's say we find a house that we ultimately love. We like to put an offer in on it. In this market, we are in what's called a seller's market. So what does this mean? This means that we have a lot of buyers and we're very low on inventory. So what does that create? Competition, right? So you need to come in strong when you're putting in an offer. And one of the things, like Sydney touched on before, and so did Katie, something that's really great to have is a commitment letter. Right? Because you're showing the seller that you're thoroughly qualified and that they are committed to giving you the loan. You are one step closer and probably one step ahead than a lot of other buyers already. So that is something, to take advantage of. And this is, once again, when we're putting in the offer, I have communications with Sydney and I tell her, listen, this is the house. This is what the purchase price is. This is what the offer is going to be. This is what the taxes are. Can you please disclose to the buyer what her monthly payments are going to look like, what her closing costs are going to look like? That way she could feel good and comfortable about it. There should never be any surprises along the way. So we try to avoid that. And then we put in the offer. Your offer gets accepted. Congratulations. Exciting. In this market, because there's a lot of competition and there's a lot of buyers, it's very important to move quickly. But of course, just with caution. So it's very important to have a home inspection. There are often times that people, in order to want to, expedite the process, they want to look over the home inspection. I just don't ever advise for anybody to do that. I don't care if it's a new construction home. Things happen and things pop up. And it's always better to pay a couple $100 to an inspector to thoroughly review the house than to come across something that needs to get fixed down the line and it costs you thousands of dollars, hundreds of thousands of dollars. So always have a home inspection. And that takes place immediately after you get an accepted offer. So the inspector is going to give you a report. It's usually a 24-hour turnaround. And 3 things can happen from an inspection. You can either ask the seller to maybe agree to some repairs. You can be advised and, be told what the repairs are needed to be had, and you could try to fix them yourself and kind of get an estimate of what that costs you. Or if you feel like maybe this is too expensive and too much for you to take on, you can walk away from the property at no commitment. The only thing you're losing out on is a couple $100 that you pay the inspector. And then we can continue the search or we can move on forward. Once we move forward, I like to create, if we've agreed on some repairs with the seller, I like to say that there are no such thing as verbal agreements. And this is when I then bring on the attorney, Vincent. So I kind of like to loop him in and let him know of everything that's happening, all the agreements that, we said are going to be taken care of. And then that's kind of when contract starts to come about. So the seller's attorney is then going to prepare contracts and send them over to the buyer's attorney. So I don't know, Vince, if you want to start jumping in on at this point now.
Sure. Thank you. Before I dive into my specific topic, just two broader topics, one of which is what you're doing today. Have a team assembled before you decide that you're going to buy a house.
Yes.
Have all of these great people on your side first, rather than collect them along the way, because that'll just create some chaos and maybe waste time, which you really don't have, particularly in New York. So have your team there, have your mortgage people, your realtors, your attorneys, your lenders, et cetera. So that's important. The other thing, just a broad topic, is buying versus what? I mean, people will say, can I afford to buy a house? And they'll run their numbers and somebody will come up with a number, whatever it might be, $3,000, $3,500 a month. Okay, that's great. And you could say, well, I can't afford that. Can't afford that compared to what? I mean, what are you presently doing? Are you going to go rent for $2,500 and get nothing out of it versus buying for $3,500 a month where you get certain tax advantages? So you can't answer that question in a vacuum. You can't, if you're going to decide, you need to decide compared to what you would do if you didn't buy a house. So those are just some overarching things that came to mind. But beyond that, once I get involved, as Claudia said, it's typically at the contract stage. I'll get a document from a realtor, like Claudia, deal sheet, bind, whatever you want to call it, and it gives me the terms of what the deal is supposed to be, right? And from there, I'll get a contract. If I'm representing the buyer, the seller attorney will prepare it, and you get a contract. Well, what's a contract? It's a legally binding agreement between the buyers and the sellers, setting forth their rights and obligations, right? So it's important. It's an important document. And a document that should be gone over thoroughly with your attorney. Don't just sign a contract. It sounds ridiculous, but I've heard it countless times where I sign a contract with somebody and they're like, "Oh, I didn't think I needed that much time," or they'll be sitting in a parking lot of Target. And I'm like, it's not going to work. They're like, "Oh, last time the guy said just sign." I'm like, "No, you don't just sign it. There's a lot of important things in there. I'll run through some of them, but I'm not going to get too granular because there's a lot there. But the contract will set forth the obvious things. I mean, what are the terms of the deal? How much are we buying it for? How much are we putting down on contract? How much is the mortgage amount? It's all in there. What's the balance due at closing? So that's in there. That kind of dovetails into what Sydney was talking about, the mortgage, and we have a clause in there. It's a mortgage contingency clause. And people are nervous, like, well, what if I don't get a mortgage? So do I lose my money and I get my money back? Well, no, the mortgage contingency clause will say that your obligation to purchase is subject to and conditioned upon your ability to get the mortgage, as set forth in the contract, though. So the amount will be in there, and sometimes there would be limitations as to what kind of a mortgage you can go for. The contract might say, subject to your ability to get a mortgage other than a VA, FHA, or governmentally insured loan. So if that's the case, that should have been something you agreed to when you signed the binder, if you will, with Claudia, right? So did you agree to that or not? Because if they're going to limit your ability to get an FHA, we need to know that, because it's going to be in the contract and then you're going to be legally bound, right? So, and I won't go down that road. That's for Sydney to talk to you about. There are some limitations, with respect to FHA and everything's risk and reward, right? With lending, like anything else, any other investment, right? There's risk profiles and that changes things. So you need to flesh that out. There will be another clause in there that says, well, when am I going to close? And in New York, we use this concept called an on or about date, which why what we do. In other jurisdictions, it's not that way. On or about some date. So on or about June 15th. Doesn't mean June 15th. It's a window of opportunity. And we typically say 30 days. And even that's not cast in stone. Okay. So if it says on or about June 15th, we're typically going to close between June 15th and July 15th. And neither party can hold the other party's feet to the fire as long as they close within that window. So you want to make your plans accordingly, and particularly dovetailing into something that Sydney had said before, when you lock in a rate, please be mindful of the on or about date with your mortgage lender, right? So some people will lock in a rate. They'll come back to me, and even though I tell them during the contract signing process, do not lock in a rate that does not comport with the contract, or at least call me before you do it, right? Because they'll say, I got the greatest rate in the world. It's good for 30 days. And I tell them that that's the greatest rate you're never going to get, right? Because you're not going to close. I mean, that's the bottom line. So you want to make sure that that's covered. Within the contract, you'll also have, we'll talk about title. The essence of what the seller must give you is good title, obviously. I guess that goes without saying, meaning clear title. You wouldn't want to buy a house without clear title. And in fact, you couldn't, because the lender won't give you any money, right? So that'll be addressed in the contract as well. And so once we flesh that all out, we sign the contract, we send it back to the seller's attorney, we send the contract deposit. And just parenthetically, today we do things a little bit differently. It was happening before COVID, but certainly after COVID. A lot of what you're going to be doing is going to be done electronically. You'll sign documents by DocuSign typically. Some people say, no, I must come in. Okay, then you come in. You do, you'll make the down payment. Used to always be by check. Now more often than not, it's a wire. But that's minutia. But people do have that question, so that'll happen. Once the contract's signed, it goes back to them. Seller will sign, send it back to the buyer's attorney. At which point you're in contract, right? And you'll need that contract to provide to your mortgage lender, because that's an essential part of the process, the underwriting process. They want that contract, obviously. Title gets ordered. So what is title? The buyer's attorney in New York will order the title search, typically almost universally. And I'll get a big report as the attorney, as will the seller's attorney, as will the lender and the lender's attorney, to make sure that everything within it is as it should be. Are there any open building violations? Are there any open permits? Are there any substantive title issues? So, liens, encumbrances against the property that may or may not be known to the seller. Chain of title issues. Are there any problems with the seller's interest in the property? All of that will be in there. The taxes will come up. They'll do a CO search. CO can be thorny in New York. And a lot of it has to do with the lender. A CO stands for a certificate of occupancy, or you might hear it be called a certificate of compliance. In New York, the municipalities will want you to have one of those things for almost anything that you build, right? And people think it's only for like the house or the main structures. That's not true. Why? For obvious reasons, right? The municipality, it's money, right? They're going to charge you for applications. They're going to charge you for a whole host of things, but also there's a reason for it, right? They want to make sure that things that are built safely and in accordance with the code requirements, right? So those COs will come up a lot because on Long Island, people will routinely build certain structures without the benefit of getting a CO or a certificate of compliance, right? What are those things? Sheds, decks. People routinely build them. They don't get the municipality involved for various reasons. But those things will come up, and that will be addressed in the contract. As I said, we want to make sure. A lot of attorneys on Long Island now, particularly sellers' attorneys, when they draft the contract, they will exclude those things, saying that the seller will give you a CO for things that require a CO, except, and then they'll list as many things as they can exclude and get away with, right? Shed, deck. So it's a two-part question. The threshold question is your lender. What do they want, right? Because if you can't get the lender's money, you can't buy the house. Doesn't matter what our opinion is. So if the lender says, look, we're not too worried about, and maybe Sydney can jump on when I'm done or at some point and say what their position is, and I know they're quite good with this. We're not going to worry too much about a CO for a deck, first floor deck. We're not going to worry too much about a CO for a shed. All right, so you pass the threshold question, which is the lender question. The second question is, how do you feel about it? I, as the attorney, will give you my input and my advice. Would I not buy a house because it didn't have a CO for a shed or a deck? No, I would buy the house, particularly in this market. If you're lucky enough to find a house you want, I would buy the house. If you don't have a house for something far more significant, like a dormer or an extension, again, you have to revisit that, and the lender would give you their perspective. And obviously, I would tell you what my position is with those kinds of things. So that all of those things will be fleshed out during that process and the title examination. The title examination, once we go to closing, which I'll get to next, upon the payment of a premium, which is regulated, by the way, you shop for title, but you're not shopping for that because that's regulated by the insurance department. So you'll pay a premium, comes right out of a rate book. You're buying title insurance for you and the lender, right? You pay all the lender's fees, right? Nobody pays to lend you money. I wouldn't pay to lend you money, and nor will anybody else. So you'll buy 2 title insurance policies, and upon the payment of the premium, that search that I just discussed turns into a policy protecting you and protecting the lender. All right. All right. So we go through that whole contract phase. We go through the title examination. Everything is as it should be, or hopefully it is. If it's not, we fix it if we can. And then we get to the point where Sydney said you get the magical clear to close, right? Clear to close means that your lender's satisfied both from an underwriting perspective as well as a legal and title perspective. You can schedule a closing, which will be done with the respective attorneys, the buyer's attorney, the seller's attorney, and the lender's attorney, typically the lender's attorney. You'll do a walkthrough with Claudia, right? Make sure that the house looks like it did when you agreed to buy it, right? Reasonable wear and tear, except they're going to live there, right? For the next 2 months, people are going to live there, right? And you want to make sure that it looks like it does and that things are in working order as per the contract. The plumbing, heating, electrical, mechanical systems and appliances are in working order. The roof is free of leaks. So those are the representations that you'll get in the contract. You'll get a letter from our office telling you that you need to coordinate the utilities. We have somebody here who will help you do that. Make sure that when day of closing, utilities go on. Seller's attorney will coordinate, utilities go off. I would go over the numbers with you, meaning what numbers, what dollars do you need exactly for the closing and exactly how do you need them, right? The closing disclosure, you will probably have gone over with Sydney already and probably myself before that, but we would do it again. And then we would tell you exactly when you come to closing, you need X number of dollars based upon the contract and certain adjustments they're under. And we tell you, we need 5 checks this way, this way, this way, this way. And people will sometimes ask me, well, I'm buying from Mr. and Mrs. Jones. Why am I writing a check to Chase Mortgage? Well, because they're going to use the money that you're providing to satisfy their obligations, one of which could be the payoff of their existing mortgage, or perhaps they're going to buy a house that afternoon or the next day, and they're going to bring those funds someplace else. So we'll go over all of the numbers so you know exactly where you stand with respect to that. And then what's going to happen at the closing? What is a closing? I mean, people say, oh, we talk about closing. What is it? In New York, we have what I call an event closing, unlike other jurisdictions. We get together, all right? We're New Yorkers. Buyer attorney, seller attorney, lender attorney, title company, realtor. I mean, there's a bunch of people there, right? And we get together and we go through a process. And you as the buyer, you're going to be dealing with multiple parties. With your attorney, you will sign all of the closing documentation, all of the documents that the lender will provide in order to give you the money, right? The most important of which is you've heard of the note and the mortgage. And just as an aside, the note and the mortgage is not necessarily signed by the same parties. So maybe a husband and wife or whatever the relationship might be, 2 people are buying a house. Maybe only one person is borrowing the money, right? They would sign the note. But both people are going to own the property, so you both would sign the mortgage. The note is the promise to pay only, but the mortgage is the pledge of the collateral. So you would both sign that. So that sometimes throws people for a loop. Sometimes they don't know why that's happening, but that's what's going on there. And then there's, depending upon the lender, there's a plethora of other documents that you will sign to satisfy the lender. That all takes place upon the completion of that and the review of that by the lender's attorney. They'll be satisfied. The loan will fund. And we'll disperse all of the checks at the time of closing. Once you pay the full purchase price as agreed to by everybody, the closing is essentially done at that point. The documents are tended to the title agent, or title closer, people call it, for recording, etc. So that'll be basically the conclusion of that closing. And then you'll get a set of documents from my office copying you on everything that you signed so that after this blur of activity, you have some clue as to what took place, right? And we'll advise you some other things. You'll, of course, want to make an application for your STAR exemption for your real estate taxes to reduce your real estate taxes. And that would be your complete closing process. So that's it pretty much in a nutshell from when I get involved. Obviously, there's a lot more that goes on through there, and there's a lot of give and take, and we pull in different parties to this as we go along. There might be some clarification that's needed from Claudia, and I might have to get in touch with Sydney to flesh out some of the mortgage details, et cetera. But one of the other things that just popped into my head is I can't remember who said it, whether it was Sydney or Claudia, but verbal agreements are irrelevant. So when we do the contract phase, anything that was said to you, unless you tell me and I put it in writing, is irrelevant. So if the seller said they were going to do something or anybody said they were going to do anything, you need to tell your attorney on the front end so that it gets memorialized in the writing and it gets signed by the party that's to be charged. So.
Right. And I think that's also my job too. I like to create a paper trail where the attorney and the buyer is involved. I like to take photos and snaps from the inspection report, any notes, and kind of just all have it in an email, just so nothing kind of falls through the cracks. And we always have something to fall back on, which is extremely important. Another factor too, is just when I send in an offer, I like to send in the original MLS listing, just because on there are some disclosures that they can always alter and you don't ever want them to change that up on you. So those are just a couple of other things that, just to add security onto the transaction.
Agreed.
And I did want to jump in really quick and just touch on two things that Vincent said. Because I didn't touch on it. One was programs. When he was talking about the contracts saying you couldn't do certain programs, that is something when I'm building your file that I figure out which program is best for you. It's not really for you to choose which program you want to, because you don't know the ins and outs of it as a buyer. And I can see which program will be best for you. Maybe you're a veteran, but a VA loan isn't best for you in this case scenario. Maybe you qualify for conventional loan, but an FHA is going to give you more seller concessions, or you're allowed to get more seller concessions. So we should go FHA. There's a lot of different reasons and whys to what program we put you in. But of course, it's all with your best interests in mind. And I typically go over with my clients why I'm putting them in that program, why we can't do other programs, and what the pros and cons of that are. Or sometimes I present two. Sometimes two work and they have different benefits and downsides, and you get to make that decision. The other thing I just wanted to touch on quickly was the COs. Correct me if I'm wrong, but do a lot of people not get COs because it'll increase their property taxes as well?
That's not necessarily true. I mean, we say that, but that's not always the case. I think it's more a function of they don't want the municipality or the town or whatever you might be in on their property. Okay. Because if I build a shed and I call the town to come and do an inspection, and the inspector notices, in addition to what I did build, there's A, B, C, and D there. And now they want to be involved in that. They won't give you the CO for the shed that I called them about until I fix the pool that I put in and the this and the that and so on.
Got it.
And it's just a time crunch. I want to build a simple shed. I want to walk in my backyard because I need a shed, or because I want to do something with my son or whatever. I don't know. I want to build a shed. I don't want to start making applications and get drawings and spend the money and spend the time doing it. And so they just do it. I mean, simple things. If you put in central air conditioning, you're supposed to get a certificate of compliance. I mean, if you put in a fireplace, a gas fire, pretty much everything. Think of it from the town's perspective. They want to be involved in everything, and they want to collect your money for everything.
One of the things that is very obvious here is the importance of experts, because there are so many different nuances to buying a home. What sets these professionals apart from others is their attention to detail. The fact that Claudia is making notes about the things that are discussed. The fact that Sydney is figuring out what is the right for you to select that's the best financial, makes the best financial sense. The fact that you get all of these resources to help people at no charge to make the right decisions. The fact that Vincent is looking at the agreements and making sure that everything's in writing. This is why in the day and age of the internet and being able to search things, and you think you can do it on your own, you can't. Because you really need the shepherding of professionals.
And you shouldn't.
You are going through this large, incredibly, probably the largest investment of your life, and the most pivotal, your home decision that you're going to make. You want to make sure that you have a team and that you have a professional team. And what this team brings together too is they know each other and they work well together. That's a real blessing. But I think this was such great information. I do want to get to some of the questions we have here. because there are a few questions I want to get in, and I know everyone's been patient, but the information that you all are providing is tremendous. Seeing it in the chat. Thank you so much. Thank you so much. And I have a question here from Shayla. Who is responsible for the attorney fees at closing?
Who's responsible for the attorney's fee? Okay, so the sellers will pay. I mean, look, you can negotiate anything, but generally speaking, the sellers will pay the seller's attorney. The buyers will pay the buyer's attorney, but the buyer will also have the pleasure of paying the lender's attorney, right? As I said to you before, the borrowers pay all of the expenses of the lender, and they have attorneys representing them, so you will pay that fee as well.
Thank you. Thank you. Elvira wanted to know, what's the best way to save for a house? Where do you put your money that's not taxed? Any recommendations, or should we refer another expert?
I think it really is just a personal. It's going to depend on the person, your job, what kind of, some jobs have different programs and whatnot that help you either save for a down payment or will, allow you to take some 401k. So that's some things to explore. I think definitely, keeping your money in a savings account. Hopefully now, rates are going up to borrow money, but that means rates are going up, on your deposits as well. So, it depends how much money it is, but of course, like a high yield money market account could be useful. A CD account, even if you're not looking to buy for a certain length of time, you can keep that money in a CD and let it mature. So there's a lot of different ways, but I think ultimately just getting started and putting that money into an account. I get a lot of clients that have, I have $50,000 in cash in my mattress. That's not going to work. You can't deposit that into your account, and the underwriter will absolutely not allow that. So, making sure, I get a lot of people that don't trust banks, etc. You're insured up to $250,000 under the FDIC. So put the money in the bank. Hopefully you can find something to help it grow, but definitely just keep it in an account.
Thank you, Sydney. Danielle wanted to know, what if I wanted to build my first house? Would I be able to get a loan to start building my house? Like you had mentioned earlier, that the 203K about the improvements. Can you get that for building a house?
You can get it for a construction loan for complete construction. We don't get too many of those, but definitely we do them at Clifco. That was something I did want to touch on was the amount of programs we have for self-employed individuals. Past the FHA conventional VA options, we have something called non-QM loans. And I won't go into in depth so we can get to more questions, but basically there's different programs for a lot of different borrowers. We use 1099s instead of tax returns. We use business bank statements instead of tax returns. A lot of this is because, especially if you're self-employed, you're writing a ton off your tax returns. So your net income is actually a lot lower than what you're actually making because you're trying to avoid paying Uncle Sam. So there is programs that we have to use a different form of income verification, such as, like I said, 1099s, business bank statements, verifications of employment even. And then the other thing was the new builds, the construction loans, all that good stuff. And the other thing I wanted to touch on briefly, really quick, was the COs again. That is something like the depositories, Chase, Wells Fargo, they won't close the loans without a CO. A lot of lending companies won't, especially if they're not local. Open permits, that can be up for discussion with Clifco as well. So I do have the ability to close those loans with no COs, sometimes even with open permits. So
thank you, Sydney. Charlotte wanted to know, with home prices at an all-time high, what are tips for finding properties that won't break the bank? Claudia, maybe that's
there's a different couple of routes too. I know a lot of people, there's short sales that you can go about. Like I said, sometimes you don't want to get or need to get the most renovated house. I think that you can always go the route of getting a fixer upper. I think that that's a great way to increase the value on your house and also create equity as well. So it depends. There's a couple of different routes.
Well,
Yeah,
I
you
put
can also-
everyone's contact information, so please do call. Katie, do you have an answer?
Right. Yeah, you can also tap in. There are some down payment assistance programs,
Yeah.
closing cost programs. Every lender is different. Definitely reach out and see what they have. You might think a home is out of reach, but it might be in reach with those programs and incentives for sure.
And
There's
that's
grants
part of,
out there as well. Yeah.
that's part of our initial conversation as well, and me finding a program that's best for you. I do have access to like Sony May, which is a New York State program, low interest rate programs, down payment assistance programs. Now, again, if it sounds too good to be true, it probably is. These programs are meant for people with low incomes and still low debt to income ratios. So it's really hard to find people that do actually fit this exact mold, but it can be done. And then when you said the question about finding a home that doesn't break the bank, I do want to bring up refinancing as well. As long as you qualify and can pay that payment, we can look at your options of refinancing down the road and talk about what that will look like to get that interest rate down. Now you have more equity in your home. We may be able to take off mortgage insurance now off that monthly payment because you have enough equity, get you a lower interest rate, and lower your monthly payment by hundreds of dollars. So, that is an option if you get into the house now and start building equity now and just kind of bite the bullet on that mortgage payment, as long as you can afford it, because we never want you in something that you can't afford, obviously. But there are options to move around your money a little bit. I always have loved finances because I always say you can really make your finances work for you, right? Whether that's pulling equity out of your house later to buy another one or just refinancing to get a lower monthly payment. There's definitely options out there for you to do that in the future.
Right.
And if I may jump in for a moment, in that regard, what Sydney just said, that potential for refinance, what you might want to consider, and you'll talk to Sydney about this certainly, is that there's, as she said, there's all kinds of programs, and people are, when they hear an adjustable rate loan, they get nervous. They say, oh no, I was always told never do that. But there's a lot of great programs out there where you could get a 10-6 ARM, meaning the rate is fixed for 10 years, but it's a lower rate. And then that gives you 10 full years locked in at that lower rate than the fixed rate 30-year mortgage, to then have the potential to refinance as Sydney was just discussing. So your circumstances are different. So if you put those two things together, the lower adjustable rate on the front end, knowing that I have 10 years to refinance. Look, nobody knows what rates are going to do, but having done this as long as I can, that's what they do. They're up and down. How long they last depends on the cycle. But that's another plan. You might say, look, yeah, I'll take that 10-year adjustable with the view towards either reselling or refinancing.
Yeah, I think that. Go ahead. I was just going to say that I think, nobody's situation is the same. So, buying a house is just not one case scenario. And that's why it's just so important to at least have the sit down and have the conversation and just kind of map out, where you're at. And that way, what steps you need to take to get you to becoming a homeowner. But, don't put yourself in a position where, because you feel you don't have savings, you don't have money, or your credit, or, whatever it may be, don't opt out already. Just at least have a conversation, and that way you can get started.
And sorry, I do want to go off of that. I know we just have like so much information we're dying to share, but even if you feel like you're not ready yet, or you're like, my credit score sucks, I don't have savings, I only have $5,000, whatever it is, reach out and have a conversation, because there's guidelines and things that you don't know because you don't work in this industry or do this every day. So we can come up with a game plan for you. So for example, for me, with some of my clients, even some of them, I'll give them a pre-approval letter. They do qualify, but while you're looking for a house, let's take these steps so I can get you a better rate and lower closing costs. And a lot of that time, in a lot of cases, it's the credit score. And, I work with a woman who has a business helping people with their credit. And it's not just like, oh, here, pay down your credit cards. It's actually fighting the credit companies or the credit bureaus to take late payments and to take collection accounts off of your credit report altogether. So even if you're not ready now, have a conversation so we can educate you on how to get there. Because the worst thing you want to do is spin your wheels for a year thinking you're going somewhere, and you're not realizing that A, B, and C need to be done before D.
Absolutely. Well, this has been so incredibly informative. And honestly, we could stay here the entire afternoon because there's so much good information. But I think, the most critical thing is there is so much information out there. And these are the experts that can get you the answers and get you prepared to own your own home and to stop paying somebody else's mortgage this year. I put in the chat all of our panelists and their contact information. You will also get an email tomorrow with the recording of this webinar along with their contact information too. So if you didn't pick it up right now, that's okay. We're going to get it to you as well. You'll be able to watch this, share it with your friends, share it with your community. This is invaluable information from top people in this industry who do this every day. So make sure that when you're buying a home, you are working with those people who have this important information. I want to thank them for being here. Thank you, Vincent, Katie, Sydney, Claudia. Thank you so much for your generosity with all this wonderful information. And thank you to all of you who joined us today. I hope this was valuable for you, and best of luck in finding your home for 2023. Thanks so much, everyone. Great afternoon.
Thank you.
Bye.
Thank you.